Hello everyone, we are super excited to launch 360-degree study kit with some of the most powerful upgrades to your classes. With this 360-degree study kit, you can now take a practice quiz at any point of time while attending a class. You can get a summary of your entire class for a quick revision. You can get your favorite teacher's presentation in downloadable PDF format. Also, you can make your own notes while learning and save them. Last but not the least, if you prefer a fun way of learning, you can even use flashcards to test your understanding. These upgrades with 360-degree study kit will now supercharge your learning even more.
Hey everyone, welcome to the video on report on trend and progress of banking in India financial year 2025. So recently RBI released this report on trend and progress of banking in India. We are going to have a detailed discussion related to this report in this particular class, right? So guys, we have introduced the 360-degree kit for your smart revision after every class. So after every class, instead of rewatching the video or making the notes again and again, what you can do is you can learn, you can revise and practice in about just 10 minutes with the help of this particular feature. You will find the summary notes, questions, right, quizzes, flashcards, everything in this particular feature. So this is going to be a very crucial feature for the preparation of your RBI Grade B or any other regulatory exam preparation, right? So guys, the report on trend and progress of banking in India is submitted to the central government in terms of section 36, right? So this is a regulatory requirement, right? As per the Banking Regulation Act 1949, section 36 subsection 2, you have to submit, the RBI has to publish a report which is called as the report on trend and progress of banking in India. Okay, so just like you guys have to study this report compulsorily, RBI also has to publish the report compulsorily, right? It's a regulatory requirement, not just a report. And we can see here in this particular letter also, in pursuance to the provision of section 36 subsection 2 of Banking Regulations Act 1949, the RBI has released this report signed by the Governor of Reserve Bank of India. So guys, this is the, I will say, these pointers are the core highlights of the report on trend and progress of banking in India, right? We have to definitely cover these highlights. At the same time, we have to cover this report in a detailed manner also. So this video will be exclusive coverage for the report on the trend and progress of banking in India. And guys, in case if you are having any queries related to finance, you can join my Telegram group. If you type CA Pratik Finance on Telegram, CA Pratik Finance on Telegram, you will get my Telegram group. I frequently share finance related content on that particular group. You can also directly get in touch with me if you have any queries related to finance. So here we can see that the Indian commercial banking sector remained resilient during financial year 2025, supported by double-digit balance sheet expansion. So the balance sheet expanded with a double-digit growth rate, right? The deposits and credit of the scheduled commercial banks were also in double-digit growth mode. At the same time, the capital to risk weighted assets, the CAR, capital adequacy ratio, or CRAR of the scheduled commercial bank was 17.4%. So this data, you can't ignore this data, okay? You can't ignore this data. At the same time, from the report, I'll be highlighting multiple things that you have to cover. Then they have talked about the GNPA as well, gross non-performing asset as well. They are also at a decadal low of 2.2%, right? As on 31st March. And if I talk about the September 2025 data is also included in this report. That's why I can say that this report is not just for the financial year 2025, but for the half year one of financial year 2026 as well, right? Then they have commented on the profitability, that the profitability also was fine. There was an increase in the return on asset as well, ROA, which we study in the ratio analysis. Return on equity was also good, right? And then we have to discuss about the urban cooperative banks and NBFC. So if I talk about this particular report, this report is divided into 6 chapters, broadly into 6 chapters. Chapter 1 is nothing but perspective. Chapter 2 relates to the global banking developments. Chapter 3 is related to domestic policy environment. Here we are talking about the perspectives, then global banking development, whatever is happening globally in the banking side, right? The third chapter relates to domestic policy environment. What is the policy environment in India as of now related to banks? Fourth one specifically commercial banks, cooperative banks, and sixth one. This one is going to be super important. Commercial bank and NBFC portion is also going to be important. Now this report is a big report, it's 200 plus page report. So I'll be covering the crux of this report, of the things that can be important for your examination. Definitely it will be an exclusive coverage only, but I will highlight those things that can be important for your examination. And as I always say, that reports are nothing but compilation of RBI circulars, finance current affairs, and news related to RBI and banking. And that's what a report is. So whatever things happened in financial year 2025 plus the first half of the financial year 2026, it is nothing but the compilation of all the events. So it is definitely helpful for revision of the finance current affairs, for RBI circulars. At the same time, you can use the terminologies of the reports, the sentences of the reports, key sentences of the reports while writing your descriptive answers as well, right? So let's start with the perspective, guys. Chapter number first, the Indian banking and the non-banking financial system. So the banks as well as the NBFCs, they remained robust, they remained supportive of growth, and financial inclusion was also at an all-time high level, right? So let's start with the perspective, guys. Here we can see that the Indian banking remained the resilient and strong balance sheet was there, sustained profitability was there. So that's why we can see that the ROE, ROA figures are quite good. Slowly we will try to understand each and everything. So this is just a start. Even if you are not able to understand some of the terminologies, no worries at all. We'll be doing a detailed discussion about each and everything, right? So the balance sheets were strong, the profitability were also sustainable, high capital buffers, we are maintaining high capital buffers, right? NBFCs also recorded a robust performance supported by the double-digit credit growth rate and improved asset quality. So we are going to one by one discuss about each and everything, okay, in this particular video. Now the regulatory framework is based on 5 principles. The very first thing that you have to remember is this one. The regulatory framework is based on 5 principles. The first one is proportionality, then consultation, evidence driven, principle based, and agility, right? So these are the 5 broad principles on which any regulatory framework is based. And you all know that Reserve Bank of India has consolidated recently 9,000 existing circulars related to the Department of Regulation into the 444 function-wise master direction, and we can see that in the month of November 2025, there are so many circulars which are consolidated, right? Then if I talk about the expected credit loss, as of now we are following the incurred loss approach, right? Incurred loss approach, and the provisioning is resulting in delayed stress recognition also. So what the RBI is doing is, the RBI is proposing the mitigation of the scheduled commercial banks and for the AIFI and migration to the expected credit loss model from the 1st of April 2027. So this is an important update. So as I already told you guys, our report is nothing but an excellent compilation of finance current affairs and RBI circulars. Next para is related to the deposit insurance. We all know that RBI is having a wholly owned subsidiary which is DICGC, Deposit Insurance Guarantee Corporation of India, and as of now the system that we follow is a flat rate method, is a flat rate premium method. So let's suppose if bank has to get the deposits insured by DICGC, bank has to pay 12 paisa, bank has to just pay 12 paisa on 100 rupee, right? So if you have deposited anything in bank, for example 100 rupee deposit you have made in the bank has to pay 12 paisa to DICGC for the insurance, right? So your deposits are insured up to 5 lakh rupees, right? Your deposits are insured up to 5 lakh rupees as of now in India. But the problem is we have different banks, for example HDFC Bank, then we have SBI Bank, then we have IndusInd Bank, we have Yes Bank. Every bank has to pay 12 paisa. Every bank has to pay 12 paisa. So this is a bit unfair, I can say, or this is more related to a flat rate of 12 paisa rather than rather than a risk-based approach, right? A risk-based approach, because every bank is having a different risk. So that's why here RBI is transitioning, right? RBI has introduced a framework so that we can transition towards risk profile. The premium should be linked based on the risk profile of the different banks. So definitely Yes Bank has to pay more for the premium. HDFC Bank, being a stable bank, has to pay less for the premium amount, right? Then if I talk about the global banking development, now in this particular chapter we are having multiple things related to the global banking, whatever things are happening in the advanced economies, in the emerging economies. So we'll be discussing about the global stuff in this particular chapter. So here also we can see that the global banking structure, the global banking system remains resilient, right? And it is reflected in the strong capital buffer that the global banks are having, high leverage ratio, improved profitability. So whatever ratios as of now we have in India, these are the global standards, right? These are the global standards. Even if I talk about liquidity coverage ratio, PCR, CRAR, it's not like that we are just maintaining these ratios. The Indian banks are required to maintain these ratios, but worldwide these ratios are acceptable, right? Because that is the requirement of Basel norms. And we can see here that the central banks have responded with monetary policy easing. That means most of the countries are cutting the interest rates, just like India, right? So if I talk about the global growth, first let's talk about the global growth. It is projected to decelerate to 3.2% in 2025. So global growth, (3.2%) in financial year 2025 and 3.1% in 2026, right? This is the projection. This is the projection. So from the last year 2025, which was 3.3, now we are moving towards the deceleration of the growth rate. Global, this is the global growth rate, not of the India's growth rate, right? The emerging market and the developing economies, the EMDEs, are projected to grow by 4.2%. 4.2% in 2025. In 2025 and 4% in 2026. So this is for the emerging markets, right? Obviously they can grow at a faster pace. Why? Because if you are a big economy, you can't grow like, very in a speedy manner. Let's take an example of an elephant. An elephant cannot move quickly, right, as compared to some other animal which is quite smaller in size, and that the same theory is applicable here also. If you are an emerging economy, you can grow really fast, but if you are already a advanced economy, your growth rate will be slower than the emerging markets for sure. Then global inflation remains light, with the headline inflation projected to decline to 4.2% in 2025, further to 3.7% in 2026. So that's the global inflation projection. Now this para from the report can be super important for your examination, both for your objective as well as your descriptive part of the examination, right? Related to crypto assets, particularly related to stable coins. So what do you mean by a stable coin, guys? What is the meaning of a stable coin? Say for example, we are having a coin, and the coin value is backed by, for example, US dollar. Like we have in the crypto world, we have USDT, which we also call it as Tether, USD Tether, right? So it is backed by US dollar itself. So can I say that this is a kind of stable coin? Why? Because just like cryptocurrencies like Bitcoin, Ethereum, Solana, the fluctuation, the variation in the value is not that much, right? So I can say that this is a stable coin. This is a stable coin. Why? Because it moves according to the movement of the US dollar or any other currency on which it is based, but the movement is quite stabilized in itself, right? The movement is quite stabilized in itself. So crypto assets designed to maintain a stable value. The whole idea is to maintain a stable value by referencing more or one or more fiat currency. So can I say that US dollar here is the fiat currency? US dollar here is the fiat currency, right? So they have now become a key component of the digital ecosystem. We all know that there are so many stable coins now, right? The market capitalization of the stable coins is approximately US dollar 300 USD billion, right? At the end of the September 2025. So this is huge. This is huge. So this is a part of system now. We can't ignore this kind of new technological currency, right? Now the Bank for International Settlement BIS has also stated that any form of money has to pass through 3 tests. Now if this stable coin, we have to check that whether the stable coin is falling in the definition of real money or not. Why? Because most of the people think that stable coin is equivalent to real money. No, it is not. Why? Because BIS is clearly stating that any form of money should pass through 3 tests: singleness, elasticity, integrity. Singleness, elasticity and integrity, and this is going to be super important. This is going to be super important for your examination. Please try to understand why stable coin is one of the most important thing nowadays. It is in recent news everywhere, and countries have started developing rules and regulations, right? Companies have started forming rules and regulation. So if I talk about singleness, the very first feature of money, one money, one value. The money should be having the same value, right? All form of money should be trading at a par value. So say for example, if I talk about 1 rupee, so 1 rupee should always be equal to 1 rupee, doesn't matter. Before 10 years also 1 rupee was 1 rupee only. Today also 1 rupee is equal to 1 rupee only. However, the value definitely decreases over the period of time due to inflation, that we can totally understand. But singleness should be there. In a currency, in concept of money, singleness should be there, right? Now stable coins are failing here. Stable coins offer trade at a significant different prices across the platform. So this breaks the uniformity wala rule, singleness wala rule. Elasticity. Money supply should expand when needed. We should be able to expand the money supply when we need it. So the monetary system must be able to expand or contract the money supply during the time of crisis, during the time of high demand for liquidity. We all know that RBI is actively intervening in the process, increasing the money supply and decreasing the money supply through multiple operations, like we can see repo operations, right? Open market operation. Recently only RBI has conducted one open market operation. Stable coins are failing here as well. Why? Because the stable coin supply depends on the issuer's balance sheet and not solely on the supply of the US dollars, right? Integrity, trust, safety and rule compliance. Again, stable coin is failing in terms of integrity. Why? Because the governance and reserve transparency issues is there. If a particular entity is saying that they keep for 1 USDT, they keep 1 US dollar in the backing, we have seen multiple cases where this statement have proved to be false, right? So there are certain governance issues even in the USDT side, right? We have seen a lot of non-compliance in the auditing reports as well. So there is a lack of transparency issue related to that, whether you are holding that much amount of US dollar in the backing of USDT or not. So in order to counteract this thing, we can see that regulations for stable coin in select economies are already there. So if I talk about United States, we do have Genius Act, right? Guiding and establishing national innovation for US stable coins act. If I talk about European Union markets in cryptocurrency regulations, MICA, Singapore, Japan, right? Japan, in every country we are having stable coin regulation. At least in 4 of these countries we do have sound stable coin regulations, and these countries are actively working for the enhancement of laws and regulations, right? So this table will be super important for your examination purpose also. And already this question, Genius Act related question, came in your RBI Grade B phase 1 exam in general awareness, if I am not wrong, right? So the BIS has identified again the concept of tokenization. The concept of tokenization now is quite prevalent. Now what is tokenization? Here we are converting the ownership or claims on real or financial assets into digital tokens. So everybody likes to handle digital tokens instead of the real assets or financial assets. So tokenization means turning an asset, maybe it can be money, it can be bond, it can be property, it can be a real estate, into digital tokens. So what we are doing here is we are converting an actual asset into digital tokens, right? So instead of trading manually, or I can say offline, we are operating the tokens via a digital system. So earlier the ownership of the assets was recorded in separate ledgers, like let's suppose somebody is issuing a bond. So I have to record that in a bank ledger, in the depository ledger, in the clearing and settlement system. But with the help of tokenization, the work is quite easy. The government bonds now exist in digital tokens. The money can also exist in digital tokens. So whenever you are buying a bond, actually you are buying a token which is based on that bond, right? So this will be one system, one step, and it will be equal to instant only, rather than following so many processes, right? So now let's suppose there is a illiquid asset. You can even create tokens and infuse liquidity into that particular asset. Let's suppose there is a real estate. Now instead of selling that real estate to one particular person, what I can do is I can create tokens out of the real estate, right? And I can fractionally sell that real estate. That is also possible in case of tokenization. So this is again a new concept, right? It is also included in the report. So again, this is important, and BIS has also identified the tokenization as the next step in the evolution of the monetary and financial system, right? So this is going to change the future, I will say, of how we make transactions, how we deal with assets. That BIS is also accepting here, right? And if we talk about the asset quality, the non-performing loans to the total gross loan, we call it as NPL ratio. This is not NPA ratio, this is NPL ratio, non-performing loans to total gross loans, right? Again, it has reduced, and the provision coverage ratio is also strong. And here we are only talking about the global banks. So you can have a look at the provision coverage ratio of United States, right? The grade data is of 2024 as compared to the other countries, and we can see the position of India as well in the emerging market and developing economies, right? So this is the global data, and particularly we have to focus on the data which is as of now in India, okay? We should be having a broad understanding of the global data as well, but more specifically we need to focus on the data which is related to our country as of now and not the foreign countries. So this is the capital to risk weighted asset ratio for different countries. So as of now, India is having, in Q2 of financial year 2025, we do have 17.4, right? And you can have a look regarding the capital to risk weighted assets ratio of different other banks globally, right? Now guys, let's talk about the domestic policy environment, and from now onwards the discussion is going to be super important, I will say. Why? Because all the data that we are going to discuss now will be related to specifically our country. So monetary policy easing continued during 2026 financial year. We have seen that RBI has done so many rate cuts. I'm talking about the repo rate cut, right? And that is quite essential now. So Reserve Bank of India undertook a calibrated approach in the conduct of monetary policy to support the economic growth, as easing inflationary pressure opened the space for policy accommodation. Now the inflation is quite very well within the range, and that's what encourages the RBI to slash the interest rates, right? To slash the repo rates. And as of now, we do have, after the December cut, we do have 5.25% as the repo rate, right? At the same time, RBI has taken so many liquidity enhancing initiatives as well. I'm talking about open market operation purchase, swaps, USD by INR sell, buy sell swap, and all these initiatives have actually injected the durable liquidity into the system. Now liquidity is of two types, durable and transient. By transient I mean temporary liquidity, and by durable means this is a long-term kind of a liquidity. So RBI has injected long-term wali liquidity in the system with the help of OMO and buy sell swap, right? And they have mentioned about the weighted average call rate as well, which we call it as WACR. Now, what do you mean by WACR? Weighted average call rate, right? Weighted average call rate. What is the call rate at which the banks are doing, the financial institutions are doing overnight lending and borrowing facility, right? So let's suppose I am in need of money. I am a financial institution and I need money for overnight basis. So what I can do is I can borrow that money on call rate basis. So there are so many banks who are borrowing and lending on the basis of call rate at different interest rates prevailing in the market. Now I want a single rate that can depict the entire, all the transaction rates, right? That can tell me what is the average rate, on an average, what is the rate prevailing in the market. So I will account for all the transactions and I'll try to calculate a weighted average rate. So this is nothing but a call rate, because every bank is using different call rates. So that's why we have to calculate a weighted average call rate, which can depict the position of the call rate in any economy, right? So the WACR will be the operating target for the monetary policy. So for the monetary policy, which is the operating target, WACR is the operating target. WACR is the operating target, right? So this is called as Liquidity Adjustment Facility Corridor. Now, what is the meaning of corridor? Say for example, let's talk about this door, right? So on the top, I do have MSF, which is the ceiling limit, Below I do have SDF, which is called as the floor, limit. And in between that, the repo rate will fluctuate. That's why we call this concept as LAF corridor, Liquidity Adjustment Facility, and the operating target for the monetary policy will continue to be WACR only. This is called as the corridor concept, right? So the lower limit will be SDF, which is standing deposit facility. The upper limit will be marginal standing facility. Marginal standing facility is nothing but the rate at which the bank can borrow money from RBI in case of emergency situations. And let's suppose if a bank is having adequate money, they can park the excess money with the RBI. That's called as SDF. So SDF is also called as floor. MSF will be the ceiling, and in between the repo rate will fluctuate. And that's what we call it as LAF corridor, right? And we have reviewed the liquidity management framework as well. You must be aware that the internal working group has recommended some of the suggestions or feedback. I can say that the WACR will continue to remain the operating target, right? Will continue to remain the operating target of monetary policy. That was the first observation that we have covered in the internal working group ka report, right? That was the first observation. Then the second thing which we have discussed is to manage the short term and transient liquidity. We used to do 14-day VRR or VRRR. So we used to do 14-day VRR or VRRR operations. Now we have discontinued this and we are going to do the 7-day VRR or VRRR, right? RBI thinks that this 7-day will work better than the 14-day in terms of liquidity position, right? So the tenure will now be 7 days instead of the 14-day. So it is also covered by report. So I always tell guys, report is nothing but the compilation of all the finance current affairs of the whole financial year, right? So if you are already aware about the finance current affairs, about the RBI circulars, then no worries at all. This report will look like more than 200 pages, but effectively you have to just revise each and everything, right? That's what we are doing, right? Now, if I particularly talk about commercial banks in India, so the banking sector in India remained resilient during financial year 2025, supported by strong balance sheets. So the balance sheets are quite strong. I'm talking about the commercial banks. Profitability is also fine. Asset quality is also improved. And if I talk about the credit and the deposit growth rate, that is in double digit. The capital and liquidity buffers are fine. They are very well above the regulatory requirement, and we have created certain amount of buffers for the risk, and together the position is quite sound, right? What you guys have to remember in the balance sheet analysis is the commercial bank. If I'm talking about the scheduled commercial bank, excluding the RRB, the increase was 11.2% in financial year 2025. In financial year 2025, the consolidated balance sheet of the scheduled commercial bank has increased by 11.12%. So that is the growth of the balance sheet, right? We can have a look at the consolidated balance sheet of all the scheduled banks as well. We can see public sector, private sector, foreign banks, SFBs, payment banks are all included in this list, right? So we can see that the total of assets and liabilities are growing again as compared to 2024, right? If I talk particularly about the share of PSBs, which is public sector bank, in the consolidated balance sheet. So this is a consolidated balance sheet. In this balance sheet, the share of public sector bank declined to 54.9%. Earlier it used to be 55.2. Now it is only, there is a slight decline of 54. Now the balance is 54.9, right? So there is a very slight decline here. Also, if I talk about the private sector bank, right, they are now having the share of 37.1%. Earlier they used to have a 37.5% share, right? In contrast, if I talk about the share of foreign bank, SFBs and PBs, then it has increased. Payment banks, then it has increased. That's why I can say that they are consuming the share of private sector banks and public sector banks, right, in totality. If I talk about liability, then the deposit growth of the SCB is moderated. Now whatever deposits a bank is taking, let's suppose I have taken 1 lakh rupees from you guys. I am a bank. I have taken 1 lakh rupees from you guys in the form of FD. That is a kind of liability for me because I have to pay interest on it. Right? That's a liability for me. So the deposit growth of SCB is moderated in 2025, which was led by private bank and foreign banks, So we can have a look here. Bank group wise balance sheet composition. So the balance sheet composition is as follows in terms of deposits, borrowings, investments, loan and advances, and we can see the public sector banks. The public sector banks are doing quite good in terms of deposits. Red color is public sector banks, so 82.8% is the composition here, right? So they are doing quite good in terms of deposits. Whether if I talk about making investments, again public sector banks are at par only with the private sector banks, slightly, the public sector banks are even higher than the private sector banks. And if I talk about the loans and advances, the private sector banks are outpacing the public sector bank. The gray line is of private sector bank, the red line is of public sector bank, right? The green line is of scheduled commercial bank combined. And here we can see the bank growth deposit also, right? The bank growth deposit also, which is in a moderate trend only. And if I talk about the most important data, which is credit deposit growth, credit divided by deposit, we also call it as credit deposit ratio, CD ratio, credit deposit ratio. Let's suppose I am having 100 rupee in my pocket, and out of that I received 100 rupee in my pocket from the deposits, right? Out of that I have given 80 rupees as credit. So I can say that my credit deposit ratio is 80%. So earlier we used to have normal level of credit deposit ratio, but now if I talk about at the end of November 2025, the credit deposit ratio of scheduled commercial bank is at 80.5%, which is quite high, right? And we say that if you are lending each and everything, your deposits are 100 only, but your credit is continuously going up. So your numerator is going up, whereas your denominator is constant. That means you are not able to secure more and more deposits, but you are growing your credit. So I can say that the liquidity buffers are quite less as of now, right? Let's suppose I have 100 rupee in my pocket. I have given 70 rupee as the credit. So my credit deposit ratio here will be 70%. Now when it is 80%, I do have only 20 rupees here. Whereas here I was having 30 rupees in my pocket, right? So increasing credit deposit ratio above a particular limit can also be alarming, which is also highlighted by Reserve Bank of India in the financial stability report also, right? In the financial stability report also. If I talk about financial performance wise, now when I talk about financial possession is depicted by the balance sheet. But when I talk about performance is depicted by P&L account, right? So return on asset is increasing again. Earlier it used to be 1.3, now it is 1.4, which is good for a bank. Financial year 2026. Return on equity has broadly remained stable at 13.5%. So can I say ROA is 1.4%, ROE is 13.5%. What is return on asset? As the name says it all, return is on asset. Return is on asset. So how much return, how much profit you are able to generate by using your assets. That's what return on asset is all about. And return on equity, that means profits divided by your equity. That means how much profitability you are able to generate for your equity shareholders, right? So you can have a look at the profitability ratios as well. Now, if I talk about scheduled commercial bank, which is depicted by this dotted line, so it is at 1.3. I am talking about return on asset. Return on equity, it is 12.5. But I can see that the foreign banks, which is denoted by green sign here, are having the highest ROA, right? And the public sector banks are having the highest ROE, return on equity. And here we can see the trends in the income and expenditure account of the scheduled commercial bank. So this is a P&L account, profit and loss account. So from this account, we can ascertain how much profitability a bank is having, right? How much profitable a bank is. So here we can see that again, the numbers are growing as compared to the previous financial year, right? So we all know that how the banks are earning, they are accepting the deposits and they are offering the loans and advances, right? That's how the bank makes income. We call it as interest income. And a lot of expenses are also there, like whatever deposits you have taken, you must be paying some interest on that. Whatever loans you offered, you'll be earning interest income on that. And the margin, we call it as net interest margin. That means how much you are actually earning. So we can see that the scheduled commercial banks are having a net interest margin of 3.1%, right? 3.1%. Earlier it used to be 3.3, now it is 3.1, right? And if I talk about the provision coverage ratio, right? Provision coverage ratio. How much provisions have you made? So we can see that the data of foreign banks is quite good here, 81.5%, right? 76% is the data here for the scheduled commercial bank. You all know that in India we do have 70% as the prescribed provision coverage ratio by the RBI. We also call it as PCR, right? Then we have the capital adequacy ratio. So capital adequacy ratio means whether my capital, we take both tier 1 and tier 2 capital, whether this is adequate or not. So I take risk weighted assets here. How much risk weighted assets I have in my business and whether my capital is adequate enough to cover the risk weighted assets here, right? So why we take risk weighted assets? Because every asset is having a different risk. Say for example, I have given loan to state government. I have also given loan to Mr. Vijay Mallya. Now the loan I have given to Mr. Vijay Mallya is highly risky, right? It is having a very high risk as compared to the state government loan. So that's why in the denominator we always take risk weighted assets, right? And in the numerator we take tier 1 and tier 2 capital. So in India as of now, we need to have 11.1% as the bare minimum CRAR requirement, right? CRAR requirement as of now. And the CRAR requirement for the SCBs as of now is at 17.4%, on the year ended March 2025, which is quite good, right? 17.4% is the requirement, which is quite high, above the bare minimum requirement, right? So here we can see the capital adequacy of the SCBs, 17.4% here for the financial year 2025, and we can see the other categories as well, like small finance banks are having 21.5% in 2025, foreign banks are having 18.8%. So I can say here the private sector banks are outpacing the public sector banks in terms of CRAR, and the small finance banks are having the highest CRAR in all the categories, right? In all the categories. So for your examination, you have to learn the CRAR for the scheduled commercial bank as of now, right? And you need to remember, yes, that private sector bank is outpacing the public sector bank in terms of CRAR, and the highest category is the small finance bank, 21.5%. Then comes the leverage. Leverage ratio is a non-risk based measure. That means we don't take the risk weighted assets here. Right? So this is also a requirement of Basel norm, that you need to have certain amount of leverage ratio, and as of now in India the minimum prescribed leverage ratio is 4%. That is the minimum prescribed leverage ratio, right? And if you are a domestic systematically important bank, then 4%. If you are not, then 3.5% for all the rest of the scheduled commercial bank. So if you are a domestic systematically important bank, 4% is the limit. If not, if you are other scheduled commercial bank, then 3.5% of the limit. SCB is increased to 8% if I talk about the leverage ratio at the end of March 2025. So we only consider tier 1 capital here for the computation of the leverage ratio, right? For the computation of leverage ratio, we only take tier 1 capital, and SCBs are having 8% as of now as the leverage ratio, which is quite above the bare minimum requirement. So this was leverage ratio. Now if we talk about the liquidity coverage ratio, what is liquidity coverage ratio? Whether we do have enough high quality liquid assets that we can survive a stress scenario for 30 days. Let's suppose in the next 30 days, there is a acute stress scenario, there is a severe stress scenario, whether I will be able to survive that. If I do have high quality liquid assets, then I can easily survive that. And as of now in India, you need to have 100% in the form of LCR, liquidity coverage ratio. What is the formula? High quality liquid assets, HQLA, divided by the outflow in the next 30 days, divided by the net outflow in the next 30 days of stress condition. So this is about checking whether the bank will be able to survive for the next 30 days by using the high quality liquid assets. At least it should be 100%, but as of now in scheduled commercial bank it is already 132.6%, right? So data is quite good. Then we have the net stable funding ratio, NSFR. What is the meaning of net stable funding ratio? How much funds you have in your business, available stable funds, divided by the required stable funds. 100 rupees is the requirement, but you have only 80 rupees. You might be having only 80 rupees in your business, right? So we can say that your net stable funding ratio is 80% here, but the bare minimum in India as of now is at 100%. You need to have at least net stable funding ratio of 100%. As of now, the scheduled commercial bank NSFR is 126.4%, which is quite above the bare minimum requirement, right? So this is the March 2025 ka data, and if I talk about September 2025 ka data, half year 1 of 2026, 124.7 is the data, right? So you need to have an idea about all these datas. Important. Okay. Then coming to the non-performing asset side, the GNPA, which is also called as the gross NPA. NPA means non-performing asset. An asset which is not performing, that means you have given loans in advance to someone and as of now that particular person or institution is not able to repay you back the money. So I have gross NPAs, then I create provisions. Why do I create provision? Because I am a prudent person. I know that I won't be able to recover some money, so I will make provision for that. Whatever the amount will be there after creating provision will be called as net NPA. So if I talk about gross NPA, they are at a decadal low, multi-decadal low. They have declined, and as of now we have 2.2% as the GNPA, which is quite good, right? The net NPA is also 0.5%, I can say. So as of now, no worries. If I talk about the NPA, earlier we used to have a very high GNPA and NNPA. I'm talking about 5 to 10 years back. Now it is very well within the range of Reserve Bank of India. It is quite controllable. The slippage ratio, which measures the new accretion of NPA, how many new NPAs are there? That's what the meaning of slippage ratio is. कितने लोग slip हो गए, पैसे नहीं दे रहे, right? That is also declined to 1.4% for March 2025. So this is a good sign that the slippage ratio is going down, right? So this is the data related to liquidity coverage ratio, leverage ratio. This is the data of September and this is the data of March, right? And this is the data of net stable funding ratio, year ended March 2025. And this is the data for the gross NPAs and the net NPAs, right? For the gross NPAs and for the net NPAs. Let me just quickly mark the data. 2.2 and 0.5% respectively. Acha, in capital in the CRAR, we do have two types of capital, right? Tier 1 capital and Tier 2 capital. In Tier 1 capital also we do have CET1 and we do have AT1 bonds. So Tier 1 capital is also called as your going concern wali capital, which keeps you going. Why? Because it is high quality capital, right? It is a very high quality capital. It will help you sustain any kind of loss. But Tier 2 capital is not that much high quality in nature, and that's why we call it as gone concern capital, right? So this is the difference between Tier 1 and Tier 2 capital, right? Now next, if I talk about the frauds in the banking, it is also mentioned the data related to the fraud in the banking. So during 2025, the total number of frauds have actually decreased. So the number have actually decreased. However, the amount involved was increased. The amount was increased, right? So this is the data related to frauds in various banking operations that we can see, and the highest amount, I will say in terms of number and in amount as well, it is emanating from the advances. It is emanating from the advances. So this is the April to September ka data. And if I talk about 2025, then 13,000 from the card and internet transactions, and the amount involved was only 484 crore, right? Whereas advances again 3,518 and 15,521 is the total amount. So I can say that advances are at the top of the list in terms of amount involved, right? In terms of the amount involved. Now if we study the data, the number of frauds are in private sector banks higher than the number of frauds that are happening in the public sector banks. But if I talk about the amount involved, the public sector banks fraud are way higher than the private sector banks, right? In terms of amount, Now if we talk about credit to MSME sector, then the credit growth of the scheduled commercial bank to the micro, small and medium enterprises decelerated. It decreased in 2025, although it was in double digit only, and the priority sector lending of scheduled commercial bank has increased by 12.5% in 2025. So 12.5% increase was there in the PSL side of the scheduled commercial banks, right? Digital payment, we all know that the digital payment is being calculated here, is being measured. We do have a digital payment index, and in the March 2025, we are having the digital payment index at 493.2, which is at an all-time high, right? Which is at an all-time high. Deposit insurance, we have already discussed that we are moving towards the risk-based insurance. Coming to the financial inclusion index, we all know that there are three criteria: access, usage and quality. And as of now, we have a financial inclusion index of 67 in March 2025, right? And why we have increased why the data is increased as compared to March 2024, it is mainly contributed by usage and quality. So this we have already covered in the finance current affairs session. So the balance sheet analysis part of the RRBs are also growing by 7.6% again. We do have different other banks as well, like local area bank, like small finance bank, payment bank. Now payment banks are specialized financial institutions. The whole object is enhancing the financial inclusion by leveraging the technology advancements, right? And they can only make payments, they can only accept deposits, they can't lend money, right? So again, we are having as of now 6 payment banks in India. And if I talk about small finance bank, they are specialized institution for the formal saving avenues, right? For providing formal saving avenues to the underserved and the unserved section of the society, right? So as of now, we do have 11 SFBs, we do have 6 PBs, payment banks, and local area banks are basically small and privately owned banks. And as of now in India, we are having 2 LABs also, right? The balance sheet of all the banks are growing. The next section is the cooperative banks, right? Cooperative banks. So let's talk about urban cooperative banks here. Again, the credit growth is higher, supported by the additional borrowings and deposits. So corporate banking, the cooperative banking structure in India is including the UCBs, which are urban cooperative banks. We do have rural credit cooperative banks also, right? So UCBs are again serving the urban and semi-urban areas, whereas the RCCs, rural credit cooperative, they are catering to the agriculture and the allied rural areas, right? So if I talk about all the cooperative structure, so all cooperatives are classified in UCBs and RCCs. The UCCs are again classified in scheduled and non-scheduled. The RCCs are classified in short-term cooperatives, long-term cooperatives. Then we can have different criteria like STCBs, right? District DCCBs, PACS, SCARDBs, PCARDBs, right? Now I will be covering this concept in a very crisp manner, okay? UCBs are, we all know that, regulated and supervised by Reserve Bank of India, only RBI. Whereas if I talk about the STCBs, the state cooperative banks, this one, and the district cooperative banks, DCCBs, they are regulated by RBI, but they are supervised by NABARD, right? The supervision is with NABARD. Whereas the primary agriculture credit societies, PACs, and state cooperative agriculture and rural development banks, right, they are outside the purview of Banking Regulation Act here, right? They are outside the purview of the Banking Regulation Act here. So if I talk about the balance sheet of the urban cooperative bank, you can have a look that if we talk about the year-on-year growth for financial year 2025, it is at 4.4%. It is at 4.4%. So the total assets are growing. The balance sheet size is growing by 4.4% here. Deposits uptrend mein, credit is also an uptrend, which is definitely the deposits are helping the credit also grow ahead. Then if we talk about the financial performance of the scheduled and non-scheduled urban cooperative banks, the total income increased by 7.5% and the total expenditure is also increasing. If I talk about the operating profit, the operating profits are up by 1.9%, right? They are up by 1.9% as of now. The net profits are also growing. The net profits are also in a uptrend only. And capital adequacy wise, if we talk about the capital adequacy wise, when we talk about the tier 1 UCB, 9% is the limit, and for tier 2 to tier 4, 12% is the limit here in terms of UCB. Then 92.1% of the UCBs are already maintaining the higher CRAR about 12%, right? So that's again a good number. That's again a good number. If I talk about all the UCBs, then 18% is the CRAR ratio, which is very well above the bare minimum requirement, right? NPA wise, it is also fine. NPA wise, it is also fine. The NPA ratio here is 6.2%, whereas the net NPA ratio is 0.7%. अभी आपको ज़्यादा लग सकता है, but as compared to the previous year data, it is low only. It is low only, right? So the GNPAs are going down. As you can see in the chart as well, the GNPAs are going down and the provision coverage ratio depicted by the green line is going up, which is 90.1. So again, this is a healthy sign. Next one is the non-banking financial institution. Now we all know that how NBFCs are relevant for our country, right? So NBFCs, within the NBFC, the Reserve Bank regulates the non-banking financial companies, the housing financial companies and the AIFIs as well, right? All India Financial Institution and the standalone primary dealers. So these are the financial institutions, NBFCs are the financial institutions that are actually playing a vital role in complementing the banking sector, right? Because they do extend credit to diverse sector and they do have different segments, right? Like they can have the small business segment, they can have the micro finance borrowers and so on. So they are also serving the needs of the underserved segment of the population here, right? And they are key drivers of financial inclusion. Now you can include words like these, sentences like these in your descriptive answers, right? So it's not like that कि sir report बहुत बड़ी है, आप इसके कुछ words जो मैंने highlight कर रखे हैं, you can use these words in your descriptive answer writing as well. And when we talk about the AIFI, we all know that they are apex level financial institution and they are focusing on providing the long-term development finance to sectors like agriculture, like micro, small and medium enterprises, like housing, right? Even infrastructure. So NBFCs are regulated by Reserve Bank of India and we do have scale-based regulations for the management of NBFCs. So what are scale-based regulation? On the basis of scale, we classify NBFC as top layer, upper layer, middle layer and base layer. And they do have different criterias. Now this concept is very important for the examination, NBFC scale-based regulation. Rest we do have 5 all India financial institutions as well in India. We have NABFED, we have NHB, we have SEBI, we have NABARD, right? We have Exim Bank. All these are all India financial institution. Rest we have asset reconstruction companies as well. So please do read the classification of NBFCs based on the scale-based regulation as mentioned here. Very important for the examination, right? This is the composition of the NBFC. Out of the total 100%, in the upper layer, 30% NBFCs are falling, rest 64.6% are in the middle layer and 5.2% only are in the base layer. I am talking on the basis of asset size, right? I am talking on the basis of asset size. Balance sheet of the NBFC, they are also maintaining a double-digit expansion here, right? They are also able to grow their balance sheet at a double digit. So 19.4% is the growth rate when it comes to the asset side, right? So the growth rate is quite good. 19.4% is a very high growth rate if I talk about the NBFCs, right? And this is a summarized format of the balance sheet of the NBFCs. You can check out the numbers as well related to different categories. Now what you guys have to do is you guys have to just at a glance have to see like what are the big numbers that are driving the balance sheet, right? Like what is the highest number in the liability side, what is the highest category in the asset side. This will give you an idea how the business model of NBFCs and banks are actually, how the business model works, right? Then if I talk about the borrowing, then the major sources for the NBFCs are bank borrowings and debentures. That's how they accumulate the money for lending purpose, right? So what they do is they don't accept public deposit unless that is a NBFC deposit taking NBFC, right? So they are procuring the funds from banks, different borrowings from banks. They are issuing debentures and that's how they are able to procure their funds. And recently NBFCs have also requested RBI that the RBI should give permission to NBFCs for raising public deposits as well, which is still under consideration. As of now, only NBFC deposit taking can take the term deposits from the public, right? So we can see the sources of borrowings of NBFCs. Now, if I talk about the percentage sources, now you can see debentures and bank borrowings 36%, 36.9%, right? This is the September data. Even if I talk about the March data, then 35%, 37%. So I can say that broadly, the source of money, how NBFC is arranging the money, how NBFC is raising finance is from debentures and bank borrowings, right? NBFC D, that means deposit taking NBFC, they account for 12.5% of the total liabilities of the NBFC D at the end of the financial year, right? Now, they can only secure the deposits from the general public. And please do remember, investing in NBFCs can be risky for retailers. Why? Because there is no DICGC cover. There is no DICGC cover even if you are investing your money. Let's suppose you are making an FD with NBFC deposit taking. You won't be getting any kind of DICGC cover. The limit of 5 lakh rupees not applicable on the NBFC, right? Now, in terms of CRAR, we can see that NBFCs continue to remain well capitalized. Why? Because they do have a CRAR of 25.9% in March 2025, which is quite high as compared to the bare minimum 15%, which is prescribed, right? So CRAR wise, NBFCs are doing actually fine, right? Now is the data related to the AIFI, which is All India Financial Institutions. So we all know that as of now we have 5 AIFI: NABARD, SEBI, NHB, EXIM and NABFID, right? NABFID सबसे नया है. So these AIFIs are specifically focusing on their specialized sector, which you can see here, right? So if I talk about the balance sheet, the consolidated balance sheet of the AIFI is growing around 10.1% at the March 2025. The loans and advances are constituting 85% of the AIFI's asset growth at a robust pace, right? And here we can see that the NABARD is already commanding 49.9, almost 50%, right? In terms of asset size, NABARD is having 50%. Right, of the total AIFI, 50% to NABARD se aa raha hai, then SEBI, and then we have EXIM, NHB, and the smallest one will be the NABFID. Why? Because this is a newly established AIFI, right? And this is the AIFI's balance sheet. If I total all the AIFIs, and this is the balance sheet, and we can see that the balance sheet size as of now is 19,73,083 crore, which is growing at a 10.1% pace. After that, we do have primary dealers. Now they are doing the underwriting issuance of the central government securities, right? So what they are doing is they are buying and selling the government securities here, right? They are doing the underwriting activities, issuance of the central government securities. So the data related to primary dealer is also mentioned in the trend and progress report of Reserve Bank of India here. And these primary dealers are required to achieve a minimum success ratio of 40% in the primary auctions, right? Of the treasury bills, of the cash management bills. As of now, the minimum success ratio and subscribed to 74.8%. So the bare minimum is just 40%, and as of now, the PDs have already achieved 74.8%, which is quite high above the bare minimum, right? 74.8% is the share of PD in the total allotment. In here we can see the Indian banking balance sheet at a glance. Now this is the detailed balance sheet which we can see, right? Rest of the things we have already discussed in the respective section. So guys, if you are preparing for RBI Grade B examination, you can check out this particular course. This is with books, right? And you can later on check out the course highlights as well. And if you need mentorship, there's a 101 mentorship as well, where you'll be getting the mentorship directly from Mr. Anil, who himself has scored a rank 1 in the RBI Grade B examination. And you can check out the course highlights of this batch as well. So thank you so much guys. See you soon in some other video. Bye bye. Take care. And please do remember, don't take too much stress about the reports. Just try to cover in a very crisp manner Be strong in your basics and just try to cover the major data. You don't have to cover the entire 220-page report, right? You just have to cover the crux of it. So all these things that I have highlighted, you can just give it a quick reading and then read it in a summarized manner. Okay guys, thank you so much. Bye bye, take care. See you soon in some other video.